Welcome to this episode of CEO Perspectives, a signature webcast and podcast series by the Conference Board. CEO Perspectives take an in-depth look at a variety of topics that matter most to business leaders. To help make sense of these topics and how they'll unfold, we'll sit down with experts on a variety of subjects and do what we do best at the Conference Board, provide trusted insights for what's ahead. I'm Steve Odland, the CEO of the Conference Board and the host of this series, and I'm joined today by Dana Peterson, the Chief Economist of the Conference Board. Dana, welcome.
Hi, Steve. It's always great to be here.
And Dana, today we're talking about recession. It looks like the world economy is slowing, that the U.S. economy is sliding into recession. Lots going on. And you've just launched a new website hub to deal with this global slowdown and possible recession. Talk about that hub and the kind of information and insights that you're going to have there.
Sure, absolutely, Steve. And this hub we're hoping will be an indispensable tool for our members to navigate through this next crisis. We've had so many different crises over the last few years. We had trade wars, we had the pandemic, which is still with us in many ways, and then we had the horrific war in the Ukraine breakout, then crippling inflation around the world. And now we're talking about a potential recession. Certainly for the US, as you said, we have forecasted a recession to start sometime in the end of this year and maybe extend into the early next year. For China and Europe, slowdowns. But we have this hub that will hopefully be, we can be a great ally to our members. And just a few highlights in the hub. When you enter the hub, when you enter this experience, you will see a knowledge center. So if you don't know what a recession means or how it's defined or what different central banks are doing, you can click on that knowledge center. We also have recession tracking in real time, looking at our indicators, our proprietary leading indicators that tell us when and if a recession is going to happen. And we have insights from across the Conference Board, from economic insights to insights about policy, marketing and communications, human capital and what it means for your labor forces, ESG, and also digital innovation and digital transformation. And every week, we're hoping to update this hub with new content. There's plenty of content right now. There's about 55 different types of insights. We have charts, graphs, webcasts, the whole bit. And we're also going to be sending out an email weekly to inform our members of what's new.
Yeah, and the public can access some of this through conferenceboard.org. And then our members should go there and log in to the MyTCB side to get even more data and insights, right?
Absolutely.
Yeah. So, okay, so let's talk a little bit about what is a recession. You've talked about some of the foundational articles that are on there. How do you define a recession? I'm listening on the news to this great debate now of, is it just 2 quarters of negative GDP, or is there more to it?
It really depends on what country you're in. Some countries do define a recession by 2 quarters of negative GDP growth. They might call that a technical recession or even an actual one. In the US, it's a little different. We actually abide by the guidance of the NBER, which is an organization that actually dates business cycle peaks and troughs. And so they have this, they're kind of the officials on whether or not there's a recession. And certainly for the US, it's really about how long, how deep, and how wide the weakness may be. And so you can have a recession that's just a few months. For example, the pandemic was a recession that was called for just a few months, but it was very deep. The GDP growth rates collapsed, and also labor markets really deteriorated. And then in terms of how wide, how many industries are negatively affected, and just about every industry was negatively affected during the pandemic. And so we had a recession that was a few months long, but very deep and very wide. So again, it really depends on what your metrics are and what you're looking at in terms of which economy you're focused on with respect to recession.
And NBER is made up of business economists, and you're a member and you participate in this, and they get together and evaluate it. So it's possible that we could have a couple of negative quarters, but because the job market is so strong and it's not that wide, as you say, it's possible that they could choose not to call that a recession, even if the numbers are somewhat negative, right?
Yes, that's true. And certainly that could be true for the first half of the year for the United States in particular. But what we're looking at is what could happen later on this year, where we actually could see not only negative GDP growth rates, but also weakening in labor markets and income and all sorts of indicators.
Yeah, and we've had tailwinds coming out of the recession. Of course, you mentioned that there was this very deep short recession when we shut down the economy. Coming out of that, it was a great kind of rejuvenation, and a lot of tailwinds going on there. So now, with the absence of those tailwinds, once you remove that, that can sometimes feel like a headwind in and of itself. So it's there's a lot of psychology to this and slowing. And so how much does the consumer matter in all of this?
Well, the consumer is very important all across the world because certainly consumers, certainly in the US and Europe, are huge portions of GDP growth. So consumer spending in the US has a share of about 65%. And then if you toss in the residential sector, meaning housing, that's another 5%. So you're almost at 70% of the US economy is dependent upon consumer spending. And similar shares you can see for Europe, maybe around 50%. So if consumers aren't feeling that the environment is good and that they want to go out and spend, then that's going to significantly affect the health of the economy.
Yeah, and consumer confidence, therefore, is important. And it has been declining here, but the jobs market is holding up. And so, if the job market continues to be strong and employment continues to be strong, can we muscle through it?
Well, yes, potentially. But again, when we look across the world and we're looking at indicators of business sentiment, our own measures of CEO confidence, and also our US Consumer Confidence Index, they're all telling us that there's trouble ahead, and that potentially there's going to be slowdowns not only in the US, but around the world. And a big chunk of that is due to inflation and also how central banks are responding to inflation. Prices are rising everywhere for goods, including food and energy, services, especially housing. And housing prices are rising not only in the US, but certainly across the world. And so, with that, central banks are raising interest rates, and that slows down economies by reducing the amount of demand from consumers and also from businesses in terms of how much they decide to invest and how much labor they're going to deploy. So, all of these things are kind of coalescing into something that's probably not going to be so pretty over the next 6 to 12 months.
Well, and part of that is because these things just are not able to be dialed in. I mean, you spent an early part of your career, you spent time at the US Federal Reserve. They don't have a big dial there that they just sort of, create soft landings, right? I mean, they have a few tools and, they do their best, but interest rate hikes and a little quantitative tightening, and that alone could create a recession. Are they more concerned about a recession or inflation?
Well, the thing is that soft landings are rare, but they can happen. But the problem is that inflation is extremely high. And so right now, the Fed is more concerned about inflation than inducing what might be a shallow or brief recession in the US that has ripple effects throughout the rest of the world. So I think that we're looking at inflation that's the highest we've seen in over 40 years, not only in the US, but in Europe, across emerging markets, and also the strength of the US dollar is making inflation even worse outside of the US. So, with all of that elevated inflation, which again we haven't seen in decades, it makes sense that the Fed and other central banks are focused on tamping down inflation at the cost of, again, brief slowdowns.
And potentially job losses. And so they've said, look, we can't have this go. We'd rather get inflation down below our target. And I think the targets, have been publicly stated at around 2%. And so they would rather risk some of the other fallout in order to get that under control, I think. Is it the same outside the United States?
Well, yes, I think it's the same story. You're seeing, like I said, you're seeing rampant inflation all over the world. It's worse in emerging markets because they're much more sensitive to food and energy price shocks, which we're seeing as a consequence of the war in Ukraine. But again, I think this is a little bit different in terms of labor markets in the US as well as in Europe and even in parts of Asia like China and Japan is we're dealing with massive labor shortages. And that's because those regions I just mentioned are experiencing aging demographics. And so you have fewer and fewer people. So that means that potentially businesses may not have to let go of as many workers as, say, in prior recessions because they need those people and they've worked really hard over the last couple of years to gather and attract and retain employees. And so what we might see is, job vacancies are elevated all over the US and all over Europe, that businesses will pull down those job ads first, but try to hold on to their workers. So we might not see a dramatic increase in unemployment rates around the world this time, but certainly it's definitely going to hurt the people who do find themselves unemployed.
Yeah, so basically there's so many job openings that you would think that they would eliminate the open positions if they needed to
Exactly.
cut back, in which case you wouldn't have the kind of impact that you've seen in past recessions. So what could be the cause of recession in Europe? You mentioned earlier that the regions are experiencing some of the same issues, but there are some differences as well. How about Europe?
Sure. I think in Europe, there are two things that could potentially cause a recession. Number one, you could have worsening of the war in Ukraine. The humanitarian crisis is already horrific. Millions of people have been displaced, roughly 5 million Ukrainians. Um, but you're also seeing these disruptions to production of key grains, metals, fertilizers that are used to grow crops, also rare gases and rare earths. All of these things are being negatively impacted by the war already. But if the war worsens in the sense that Russia expands its theater of conflict deeper into Ukraine or even outside of Ukraine to impact NATO allied economies, including the US, then that's going to be much worse. That's going to cause deeper shortages, more supply chain interruptions, and even in the countries that are affected, potentially recessions because they are being they are the targets for aggression. The second issue is Europe, along with the US, is facing very, very elevated inflation. A lot of their inflation is actually linked to energy, in particular natural gas, because they were very heavily dependent upon natural gas from Russia, and Russia is being sanctioned and also cutting off supplies to Europe. And so those prices are rising very aggressively, and it's also feeding into core measures, meaning excluding food and energy. And so you could have people pulling back in consumption because of the rising food and energy prices, and also because the ECB has just started raising interest rates. It's unlikely that the ECB is going to raise rates as high as the Fed will, but certainly higher interest rates puts more of the more indebted economies in Europe at risk of sovereign debt default.
Yeah, and you mentioned earlier that some of the developing nations were, more affected by the price increases on the low end kinds of products, food and energy, for example. And this is particularly true coming out of Ukraine, where they're exporting grain. Their normal exports are to Africa and some Middle Eastern and Asian countries that are developing nations. So it also depends not only whether the war broadens, but how long do these grain shortages happen, and then the risk of potential, I guess, even starvation or famines in some of these very poor countries, right?
We're concerned about the very real risk of famine, but also with political disruption. We're already seeing instances of rioting in the streets, regime changes, and all those things are very negative for economies. The good news is that there are some economies that are well positioned to help support global grain production and exports. For example, the US and Canada and Western Europe, and also India, interestingly. So there are some solutions here, but really we need an end to the war, an end to the blockades of these grains going to these emerging markets that are quite vulnerable, both economically and politically.
So we talked about U.S. and Europe, and some of the ripple effects. The other big, huge player in this is China, and their economy is different, of course, than the Western nations. Talk about what could cause a recession in China and some of the uniqueness to their economy.
Sure. There are, I would say, three big issues for China right now. As you mentioned, China is different, where exports is a much larger share of their economy relative to consumption. And so if the US is weakening, and the US is a major trading partner, as well as Europe, especially Germany, if those two big regions are weakening, that means fewer exports for China, and China can slow materially from that external shock. The other two issues are more internal to China. So first of all, China's been having a major housing correction, and that's weighing on consumer confidence and also consumer spending. And indeed, consumer spending really didn't recover very well from the pandemic, and now you have this housing shock. And then the other issue is that the pandemic really isn't over for China. Indeed, China has this continued policy, zero COVID policy, where if the number of infections rises, then there are shutdowns of activity. There's massive testing. People are forced to stay home from work, and that when that happens in large cities that are exposed to trade, that means that manufacturing ceases, and so do exports. And so that's another risk of these repeated shutdowns. So combining all those three things, we have been downgrading our forecast for China, and there could be future downgrades indeed if the US and Europe really experience bad bouts of economic downturn.
We're talking about the potential of global slowdown and recession in certain regions, talking with Dana Peterson, the Chief Economist of the Conference Board. We're going to take a short break, and we'll be right back.
As you and your company monitor the latest wave of shocks that have battered the U.S. economy, the award-winning forecast team at the Conference Board now predicts a U.S. recession by the end of 2022. This recession will further compound the crises that have recently upended expectations, from a deadly pandemic to a war in Ukraine and the highest inflation rate in decades. Yet, unprecedented crises also present unforeseen opportunities if you have a trusted, proven navigator by your side. With that in mind, the Conference Board continues its long-standing tradition of providing timely and relevant content on a daily basis to help guide the business community through the economic storm. These trusted insights are being gathered on our website and are available to help your company master the challenges ahead. Chart a course for the future, which will allow your business to emerge stronger on the other side by visiting our free economic hub entitled Navigating the Economic Storm, your indispensable guide through the global recession, located at www.conference-board.org/topics/recession.
Welcome back to CEO Perspectives. I'm your host, Steve Odland, the CEO of the Conference Board, and I'm joined today by Dana Peterson, the Chief Economist of the Conference Board, and we're talking global slowdown and recession. So, Dana, we were talking before the break about U.S., then we talked about Europe, we talked about China. We talked a little bit about emerging markets as a spillover effect from, some of the issues in Ukraine. Any other emerging markets issues that you see or you want to discuss?
Absolutely. Emerging markets, it's really a mixed picture. Most emerging markets are suffering from extremely elevated inflation, again, spillover from the war, but also because the US dollar is appreciating rapidly. It's really outstanding. And certainly the US dollar is appreciating because the Fed is addressing inflation. It seems almost counterintuitive, but because the Fed's raising interest rates and trying to bring down inflation, the response for financial markets is US dollar strength, but that means massive depreciation for every other economy. And certainly emerging markets are much more vulnerable to to importing inflation through their currencies. And that's also feeding through to prices and consequently causing their central banks to raise interest rates. So we're seeing that happen. But then there are some emerging markets that have that produce commodities, such as the Gulf, where they are actually doing better and they're experiencing faster GDP growth And also they're engaging in more investment in areas that are not related to oil because of the massive oil windfalls amid the elevated prices. But for the most part, but even in those economies, they are seeing prices rise. So it's kind of a bittersweet moment for them. But emerging markets are also being affected by these global forces impacting upon them.
Yeah, I think sitting here in the US, you tend to think about the impact of the US dollar, the impact of fiscal spending and inflation and all of that on the US. You don't tend to think about then the ripple effect throughout the globe of the dollar, and inflation, and as you say, how it's imported and exported. And if we're going to be a good global citizen, we really do need to caretake the US economy and the dollar and all. We have to take care of all these things because it impacts so many people around the world.
Indeed.
So, Dana, what do we hear from CEOs? You're talking to CEOs around the world every day. What are they saying about the economies and what they're doing about it?
It's great. We actually have CEO confidence surveys for the United States, Europe, and China. And all three are pretty consistent in terms of CEOs believing that there's trouble ahead. Most of them are expecting that there will be some kind of downturn, economic downturn or recession in their respective regions. They're also very much concerned about the war in Ukraine and the implications for business over the next 12 months. And indeed, many of them expect that there will be continued volatility in energy prices, higher costs for inputs, and also concerns about cybersecurity. They're also looking at updating their risk management programs as well as their crisis management programs.
Yeah. Now, as a former CEO, when things start slowing down, you sort of pull back on, discretionary spending and so forth. Are you hearing CEOs say that they're going to do that?
Well, the interesting thing is that they're still, at least in the US, they're still looking to hire, again, because they have these ongoing labor shortages. They're still looking to raise wages to both keep and attract people. Again, some of that might slow as we head into a downturn in the US, but businesses are also pretty forward looking. And what they're doing, and this is what we found from our mid-year Outlook survey, is that they are engaging in digital transformation. They are developing new lines of business. They're upskilling and retaining their talent. And some of them are even engaging in automation. So a lot of technology and human development, as well as looking to new areas to expand their reach.
But so does that mean that labor productivity could actually increase here during this period of time?
Well, I mean, we've seen a lot of gyrations in productivity. Certainly in 2021, productivity shot up because you had productivity is basically output divided by the number of hours. And we saw this massive surge in activity in GDP as the global economy recovered from the pandemic. And so your numerator was really strong, your denominator didn't really need to do anything. But then this year we're seeing the reverse. So what's going to happen going forward? Well, we think that investments now in digital transformation, automation, technology, also in infrastructure and R&D will be helpful for increasing productivity over the next 10 years. But again, there are many headwinds. Indeed, one of the biggest headwinds right now is inflation. It's difficult to invest if you're a business, if everything costs so much. And also if you don't have the right types of investments from capital markets. But nonetheless, we're constructive on productivity going forward.
Yeah, and if you're a CEO and you do what you were saying earlier in the program, which is you start to eliminate open positions, you basically are trying to grow and do more with fewer people. That also contributes to labor productivity, not in the way that you'd ideally like, but more, people just have to do more in order to get through things. But you also have the cost of capital going up at the same time. Do you hear anything on capital investment plans?
Well, certainly in the U.S. capital and also abroad, capital investment plans still remain pretty positive as of our second quarter surveys. We're going to have another survey in the third quarter for the U.S. and then in the fall we're going to have surveys for China and Europe. But the interesting thing, just going back to labor, is that many businesses do value their labor. And what they're doing is the number one thing that they're doing in order to attract and keep people and make sure that people are productive when they're working is promoting their hybrid work model. And we've said many times that remote work is probably here to stay in some form or fashion, but most likely in a hybrid form. Many businesses are also moving very quickly on automation. So bringing in the robots. So that's going to make up for any losses that they may have in terms of people. But they're also improving their efficiency when it comes to recruiting. And so they're hiring recruiters to make sure they get the right people such that those people will be productive. And certainly you can marry human capital with technology, and that comes from training. Many businesses are upskilling their workers to make sure that they can take advantage of the new technology that's being brought in.
Yeah, the whole hybrid work thing is interesting, but it doesn't apply universally. I mean, you can't build a house or do construction work virtually. A lot of services you cannot do virtually, and hence your point on bring in the robots, bring in more automation as much as possible to the service industry. And you see that in restaurants, for example, where people are ordering off of tablets and, they're cutting back on, the high touch aspect of it. But, how far can the hybrid work go in terms of labor productivity before, you just run against, structural walls?
Well, you're absolutely right in terms of hybrid work not working everywhere. And certainly it does not work in in-person services. But those are also the businesses that are experiencing the biggest labor shortages and have the most number of vacant positions open. And so a lot of the automation that's taking place is because they can't find workers, not so much that they don't want these workers. So if you can't find someone to come into the restaurant and wait on tables, you get a laptop or one of those QR codes, and the guests have to kind of do it themselves. So a lot of the automation is really in response to labor shortages. So I think that certainly there are limits, and ultimately you do need people. Even if you deploy technology, you need people to make sure that the technology continues to work and that it upgrades. And you still have to make sure that your existing workers are adapting to that new technology. Otherwise, technology is absolutely useless.
Yeah, and so, Dana, we've barely scratched the surface on the insights that you are developing to help our members and companies around the world adapt and change and, deal with what's coming ahead. Describe a little bit more about the range of the work that's going to be on this hub and, again, remind people how they can find it.
Sure, absolutely. So if you go onto the Conference Board's main homepage, so just type in Google or wherever you search the Conference Board, you will see that we have this wonderful carousel. And in the carousel, there is an image there advertising our hub. And so it's very easy to find. You can also type in global recession into Google and our hub will pop up. And so it's very easy for you to find. It's also quite easy to navigate. Already with the launch, we have over 50 pieces of content, which again include webcasts, podcasts, written works. We have these blurbs of information that provides a great overview of what the underlying content looks like. And that's all visible to the public. But certainly if you want deeper insights, it's great to become a member so that you can have access to everything that we have to offer.
And the range of information and insights covers economy, the strategy, finance, human capital, marketing communications, public policy, the China Center, the Gulf Center, also insights in Europe and Asia and the multiple regions. So whether you're a local firm or a multinational, whether you're in HR and trying to deal with human capital issues or strategic and financial issues, you've got it covered.
Absolutely. Yes, we do.
Dana Peterson, thanks so much for joining us today.
Thanks so much, Steve.
And thanks to all of you for listening in to CEO Perspectives. Every week, I'll be joined by an expert discussing the issues and the insights of our time. We'll cover topics ranging from the economy and geopolitics to human capital to marketing communications and more. Please share CEO Perspectives with your colleagues. I know that everybody is going to want to hear about the insights from the Conference Board. I'm Steve Odland, and this series has been brought to you by the conference.